In this week's update, how to keep the upside open but protect against a larger decline. What are the most vital indicators to watch? And gold continues to trade poorly. My name's Garry Davis. As always, this is general advice, and please remember to like and subscribe to the video. All right, let's just start with an overall perspective, which is always a really good place to start. There's a lot spoken about various indicators, and everybody has their own favourite indicators. But look, when you stand back and look at it rationally, if an indicator doesn't directly tell you about where the money is flowing between different sectors of the market, then it's really just a secondary indicator. It's not the primary source of information. And yet, judging by the comments that we get on these videos and through other sources, it seems that everybody has their own favourite indicators, and they tend to hang their hat on that particular indicator or small number of indicators. But really, we make money in the market because of where money is flowing and how that impacts prices. And so really, if the indicator is not a direct reflection of where that money flow is going, then you've just got to recognise it's not unimportant, but it's just not the most important thing that you should be focusing on. The reality of bull markets is that money flows towards aggressive sectors. That's what sustains a bull market for 18 to 20 years, which is the typical length of a bull market. The aggressive sectors in America being technology, consumer discretionary and communication services, and to a degree some of the resource areas as well. So unless money is flowing there and that's what you're looking at, then just looking at the index and looking at whether moving averages are being broken or bear flags are being formed or whatever it might be is all useful information, but it's not the main game. The main game is, where is the money flowing? Again, in bull markets, semiconductors tend to lead the technology sector. Not always, but there's a strong tendency for the semiconductor sector to lead. And not only lead the technology sector, but also to lead the NASDAQ and the S&P. And I'll come back to that because at the moment that is an interesting situation to say the least. In bull markets, we also see consumer discretionary outperforming consumer staples, and that one's almost a given. And if money is not flowing into consumer discretionary, then the market has a very defensive sentiment, and clearly we're not going to be advancing on any sort of consistent basis. Beg your pardon. Also in bull markets, resistance levels above tend to get broken, so prices continue to go up and break through resistance levels. And when prices retrace, they tend to find support, and that support holds. So that is typical of what happens in bull markets. And in bear markets, of course, you can pretty much turn all that on its head, and the opposite occurs. Resistance levels tend to hold, prices hit resistance levels and get pushed back down again, and support levels tend to break. And that's what we saw in the first 6 months of this year. I would add one other thing, and that is there are, at extremes, there are certain contrarian signals, particularly to do with the options market, that are extremely helpful in telling you where the major turning points are in the market. And we certainly started to see that in June and early July, which really, for me, was another confirmation of the fact that the bear market, the cyclical bear market, had finished, and we were back into the secular bull market phase. So looking at all things, and I covered this last week in depth, I put the opposite hat on and looked for evidence of a bear market, and to be honest, found plenty. It's not a difficult thing to do to find out there signals that are bearish. But when I step back and I look at all of it, all of the evidence that supports the fact that we're back into a secular bull market, and all of the evidence that could suggest that we're in a continuation of this cyclical bear market, the balance still supports a bull market. But we don't want to just blindly accept that, because good investing is about risk management. So what can we do if it's not? What if the bear market is going to continue, and what we've seen in the last couple of months is merely just a rally in an ongoing bear market? So we've always got to be open-minded to that. And one of the points that I've made most stridently over the years when I've been doing these videos is cultivating the ability to be open-minded and not get locked in to a certain view of how things should be. And judging by the comments that we get on these YouTube videos, there's still a lot of people out there who have a certain bias and they just get locked into it and they can't see anything else. Some sectors rise a lot. So what do we do if the bear market is going to continue? And again, this is just reality. This is what's happening at the moment. And I'll show you some charts to demonstrate that. Some sectors and some stocks can rise a lot even during bear markets. It's always been the case and always will be the case. It's just in bear markets, there's not very many of them. In bull markets, it's nearly all pretty much everything. But in bear markets, then there's not very many, but they do exist. So why not just do that? Why worry about, is this a bull market or is it a bear market? Just go with what is working. This is not rocket science. We sometimes get too hung up on putting labels on things. So how do we go about minimising or limiting the risk, but still leave the door open to participate in stocks or sectors that are going up? And the answer is that we focus on what we can control. And I've said this many times before, most things in the market we can control. There are some things we can't, but let's just focus on the things that we can control. And by that means, we can minimise or certainly limit to an acceptable level the risks of investing, but still leave ourselves exposed to the upside. And, most investors, our psychology takes over, plays with our mind, and we get spooked by the narrative of the masses. And it's really the difference between being a successful investor and not. Let's look at the scoreboard for the American stocks, and then we'll have a look at some charts. The S&P was down 3.3% for the week, so it wasn't a good week. And it's sitting now right on key support for a couple of different reasons. We've got, in terms of a month-by-month basis, the next couple of weeks is typically the stronger part of the month because of fund flows. But having said that, September is traditionally and statistically the weakest month of the year. So how the next couple of weeks plays out is a bit problematic. So you just want to be fairly careful in the next couple of weeks. The US index was up again, where I think it did get above 110 at one stage. The 10-year yield spiked up to 3.3 at one stage during the middle of the week, but did back off a bit on Friday, which was interesting, back down to 3.2. But nevertheless, the bond market has deteriorated significantly from what I was talking about just a couple of weeks ago. The VIX was off its highs for the week, but still finished at 25.5. That's certainly elevated, but it's not panic stations territory. And the 10-year, 2-year spread, which did get up into the minus 0.4s, is now back down to 0.2. It's still inverted, still pointing towards a recession, but is coming down a little bit. So let's jump in and look at some charts. Sorry. Right, we'll start with the S&P. First of all, I just want to touch on this big picture. So this is the S&P on a monthly chart, and right over here on the left-hand side is 1967. The sectors, for those that haven't seen this chart before, the sectors that are marked with a pinkish bar are cyclical bear markets, and you can see there's been two of them. And that is where we get ups and downs, we get massive rallies, we get massive declines, but we don't get new highs. So it's really a big sideways pattern. That's what a cyclical bear market is. And we had another one here from 2000 through to 2013. And then, of course, in between, we get the secular bull markets where we do get higher highs and higher lows. And yes, we do get some spectacular declines, like in 1987, where the market fell 50%. And again in 1990, and of course in 2008, over here, which was within a secular bear market. But we still get these big declines even in secular bull markets, and we've had a couple already in this one, which started in 2013. Now, based on history, and it doesn't always have to play out, but based on history, these secular bull markets tend to last for 18 to 20 years and sometimes longer. So this one on a historical basis still has quite a way to go. It's probably still got the rest of this decade to play out. Now, that doesn't mean that we can't get spectacular declines, and we've already seen several of them. 2018, 2020, and obviously just recently. So that's the big picture. But for now, we're getting higher highs and higher lows, and that's likely to continue for some time. So just remember that big picture perspective. Now, looking at the S&P, if we just put a Fibonacci retracement on this, you can see that we've come back very neatly to this support level at the 61.8% level, and it's holding for the moment. But certainly the weakness that we've seen since the peak in mid-August has been very strong. This is quite a strong downdraft. There's no question about that, and the bull market case has been weakened. In my mind, it's not been killed, and I'll explain why. And looking primarily at the sector by sector money flows, because as I said at the start, you can look at all sorts of indicators. There's dozens and dozens of them out there, but the most important thing is what is the bulk of the money? Where is that flowing? It's just the most important aspect. Now, interestingly, the equity put to call ratio in the US options market had got into extreme territory, so extreme bearishness. And you've really got to look at that as a contrarian signal. When everybody's panicking and reaching for put option protection at extreme levels, then generally you're pretty close to the lows and the market's going to bounce. And we certainly saw that through the week, and it built up to an extreme by Thursday. But interestingly eased back on Friday, despite the fact that the indices went lower. So it could well be that that we're not that far away from a bottom in this downdraft, and the fact that it could be coinciding with this support level here at 3,900 is something to keep an eye on. So that's the overall picture, the bullish case that this is a resumption of the secular bull market, and not just a bear market rally and we're going back down and we're forming new lows. That is still not the weight of evidence, but certainly the case has been weakened in the last few weeks, that's for sure. Now, if we look at the NASDAQ, you can see very similar situation. If we put the same scale on this chart, we come up with pretty much the same answer. We've done a 61.8% retracement, which is a sign of relative weakness. If this had only come down to the 38.2 or the 50, then that's a sign of relative strength. The buying strength has come in sooner rather than later. But the fact that we've made it all the way to the 61.2 doesn't kill the bull case, but it certainly weakens it. And if this breaks, then we're into renewed territory, and that's why I think it's so important now to be very focused on what you own and how you're buying into it and how you're managing it. But if we look at an individual sector basis, what has been working in America, and therefore the rest of the world is going to follow along. Well, this is XLE. This is the energy sector. 200-day moving average is still heading up, and the price is still above it. And the shorter term moving averages, they're fluctuating a little bit, but they're still in positive territory. So everything is still positively aligned in the energy sector. So don't get hung up on whether it's a bull market or a bear market. Just do this and some other areas as well, and do it according to a game plan. This is not difficult stuff. You just observe and respond. You can control the sectors and the exposures that you've got. So that's the XLE. XLF, 200-day moving average rolled over, price still below it. This is not a sector that's got momentum. XLK, similar situation. We had a really nice rally to the 200-day, but it's well and truly rolled over, and it's come off again quite sharply. And we really need to see the technology sector doing well. So this is the last week or two has significantly weakened the case that I made a couple of weeks ago, but that's fine. You just observe and respond. Don't get locked into a certain view of the world. XLV, the healthcare sector. This is really interesting because this is, you would normally expect more of a defensive kind of sector, but it's looking weak as well. XLY, the consumer discretionary sector, heavily influenced by the fortunes of Amazon and Tesla, but it's still in downtrend. The 200-day moving average was not able to be penetrated, and we're heading back down again. And you can see some significant increase in volume over the last 2 days. But it's possible that this could be the capitulation. Everybody's starting to throw in the towel at the one time. We get elevated volumes to finish the week. We're at an extreme in the options market. It's possible this could be the end of it. But certainly you need to take extreme care if you're buying anything in these sectors, because at the moment the short-term momentum is to the downside. This is a sector that really I want to see moving up, semiconductors, and it's not. So that's certainly an issue for me in terms of the overall health of the market. And this is the Dow Jones Semiconductor Index versus the S&P, and you can see lower highs, lower lows, and sharply lower on a relative basis to finish the week. So this one is not good. So semiconductors still underperforming, and it definitely weakens the bull scenario. So there's plenty of reason there to be cautious. That's for sure. Now let's look at some of the other important spreads. Okay, so this is the Nasdaq versus the S&P, and we've almost got back now to forming a lower low. So this needs to turn around basically immediately. Now the US market is shut on Monday night, but if we get any lower on this ratio here, then the game has changed, and we'd be back into something else other than a resumption of the bull market. Now, whether we just get a sideways washing machine of up and down and all over the place for the next month or 6 weeks, and then the bull market resumes, or whether we actually break these lows and we're going lower with a continuation of the bear market, that remains to be seen. Next, this is Russell 1000 growth versus value. Again, we had a great uptrend, certainly supported the bullish case, but it's looking weaker by the day, and we would hope that it would hold above that level. So we're still in play for the moment, but in the very short term, money flows have gone back towards the so-called value stocks. This is the mid-cap, and this is interesting because we did actually kick up a little bit. So this is mid-cap growth stocks versus the S&P. So this one doesn't look too bad. So I'm a little bit encouraged by that one, but it's only one of several. Consumer discretionary versus consumer staples also managed to turn up on Friday. So that's another interesting one. And this looks better than certainly, say, the semiconductor area. So I am getting some certainly mixed messages here from where the intra-market money flows are going. This is small cap growth versus small cap value. It's come off from the peak, but we still don't really have, we're getting pretty close to it. We still don't have lower lows yet. So it's another one to keep an eye on. And this is large cap growth versus large cap value on a weekly basis. We broke through resistance, but now we're back down below it again. So that's another mixed message chart from my perspective. So that's the overall for the US market. So to sum it up, we've got September is the weakest month of the year. We're in the stronger 2-week part of the month. We're getting weakening of the money flows, but it hasn't killed the overall picture. So that's probably the best way that I can sum it up. So I just sort of remain neutral at the moment. I've got more eggs on the bullish side of the ledger than I have on the bearish side, but the balance is rapidly getting back towards neutral. So it's really important, the sectors and the stocks that you buy into. That's the bottom line. Looking at Aussie stocks, our dollar, with the strength in the US dollar, ended up down at 67.39, and we fell 3.9% across the week. Looking at at what caused a lot of the selling in the Australian market, or the decline in the index, there was a lot of stocks went ex-dividend that contributed to that result, BHP being the primary one, with a very big $2.47 dividend payout, and that had a significant impact on the index on the day that they went ex-dividend. So the Australian market performance is not as bad as it looks when you understand the size of the ex-dividend payments. Materials and energy were the worst, but of course materials were heavily influenced by BHP and the dividend, and energy because the oil price had come off quite a bit. I didn't look at the currencies, so we'll just have a quick look at the US dollar. So we did manage to, not quite, we got to 109.98 on Thursday, so basically to 110 on the US dollar, but there's no denying the trend in that currency. And the Australian dollar had been doing a little bit better. Yes, it had been falling, but not falling as quickly as the US dollar is rising. And that a lot of that was due to the strength in iron ore, but the iron ore price is certainly coming off as well at the moment. So we finished back down under 68. Looking at the Australian index, sorry, that's very strange. Sorry, don't know what's happening here. I seem to have a bit of a glitch with my... Sorry, I've obviously got a glitch with Optima, so I'll just go through this and hopefully it'll fix itself. So iron ore in decline, as I mentioned. Let's go to precious metals. Gold was down by $33 to $17.14. Hopefully we'll be able to look at the chart in Optima in a minute. That corresponded, though, with the Australian dollar falling to holding steady in Australian dollar terms at around the 25.50 mark. 1680 is the key level in the sand. It's a really important level. It's been tested 6 times since 2020, and so that's that's a really critical level, and we're only $34 above that level, so that's a key one to watch. If you look at GDXJ, if we get a chance to do that, the stocks had an absolute shocker of a week before there was a turnaround on Friday in GDXJ. So hopefully there might be some better signs. But as I've been saying pretty much all year, gold is just not a sector that has momentum at the moment. I'll just give Optima a try again. No, it's not going to play ball with me, I don't think. So unfortunately, I can't show you the gold chart, but at least we got through the majority of the charts before Optima turned up its toes. Just going through the rest, commodities. Copper was down to 345, nickel down to 920, and look, a lot of this is currency and throwing a bit of fear about the China property market and demand from that area, COVID lockdowns, etc. And they're struggling a little bit in the short term, but the longer term outlook, as I keep covering, looks extremely robust for the rest of the decade, particularly from 2024, 2025. And one thing that we've learned over the last couple of years is that the explosion of electric vehicles and the decarbonisation effort around the world is moving the timelines forward. There's going to be far greater quantities required of raw materials to achieve decarbonisation sooner and sooner than what was thought even just a couple of years ago. So the long-term outlook there still looks very robust. Crude oil was lower, West Texas Intermediate down to 87 now. So we've come off quite a bit. Volatility kicked back up again. We're back up to a $12 fluctuation from peak to trough. There's a lot of geopolitical stuff going on with oil at the moment. And it might go a bit lower. But I think on the long-term picture, energy has just got to be a sector that, buying weakness has got to be a productive thing to do. There's the spot copper chart, so quite a significant plunge there over the last couple of weeks. Spot nickel hasn't come off quite as much in percentage terms. So wrapping things up, almost no one trades the index. No, not that I know of anyway. So why would we be so concerned, and so many people and so much of the media is concerned about whether we're in a bull market or a bear market? Putting a label on it might make us feel better, like we've got more control, but it doesn't actually matter. It's what we buy, what sectors we're in, how we stage our entries, how we manage, how we take profits, all those things that matters. And you can still make money in a cyclical bear market. So does it really matter what the label is at this point in time? It's harder in a cyclical bear market. There's no question about that, because there's greater pressure on stocks, there's less buying support, and there's more stocks going down than up. But you've got to remember there are still some stocks that are going up, so just do that. And some of these stocks, particularly in battery materials, are going to do outrageously well for the rest of the decade. Now, yes, they are regularly going to get ahead of themselves, and there's going to be times when they'll be sold down heavily. And that's why I think for most people's psychology, you need to have an active management plan, because our psychology doesn't deal with the 30, 40, 50% declines in the market all that well. There's not that many people that can just sit back and take a 5 to 10 year view. And, unless you're completely disengaged from the market. So if you're like the 99% of us who who have feelings and have to somehow get themselves through bear markets, then you've just got to be a little bit more organised. You've got to be more clear about what you're doing, and that's certainly what we spent a lot of time on in the Insiders Club and in Portfolio Analyst. Speaking of Portfolio Analyst, last week we looked at the benefits of the mega trends and how we can use that to advantage. We looked at US renewable energy, which is another really good sector that is likely to be productive, even if we are back into a bear market. And we also looked at copper stocks as well. And the long-term outlook for copper from 2025 through to 2030 really does look very, very strong. So that's it for this week. There's more information on the website. There's my email address. And just a reminder, the US market is closed on Monday night, but I'm sure there'll be plenty of fireworks for the rest of the week. So I'll be back with you next Sunday. Cheers.